Good morning, everybody. Thank you so much for joining the class this morning. It really means a lot to me, and I hope it means a lot to you as well. I have graded all of the papers. What we will do is devote a part of Monday's class to going over the exam and going over the homework dealing with inflation. The reason why we're not doing that today is because only 2 people handed in inflation homework so far. So I want to give the class some time to do the reading. I added this morning an article that was a front page story on the Wall Street Journal yesterday about inflation risk. And as I read it, I said, oh my God, this is a summary almost of our entire course. It talks about many of the things we'll discuss today. It talks about multipliers and multiplier effects. It's really a wonderful article, and it's called Inflation Risk, Little Now, but More to Come. I heartily recommend you read it. It's almost like a newspaper article that became a textbook chapter. I mean, it's really a beautifully written article, and it's perfect for our class, and I just can't emphasize the importance of reading it enough. There are other materials that I've asked you to read pertaining to inflation in addition to the textbook. And again, I can't recommend heartily enough that you pay attention, and this will be my only editorial comment today, that you pay more attention to the readings. The
Professor,
readings are one, yeah.
good morning. So I had a question about the exam. Because you
No,
said me
not today.
no, it's just a question, like a general question. My name is Dejana Kalemaj, and did you receive my exam? Because I sent you a couple of emails.
Yes, I did. What happened, and I'm really sorry about that, was it accidentally, or it had nothing to do with me, it went into my junk mail, and I don't know why it did, and I found it in my junk mail. But I did, I got
Oh,
it, I
really? You
graded
got
it,
it?
everything is fine. Yes, I did.
Okay, that's fine. Thank you.
Yeah, I know you asked me to respond back to you,
No,
but
it's
I was
fine.
having,
I know you are busy, so it's okay. Don't worry.
no, it
Thank you.
wasn't that. I was having trouble connecting with you for some reason. But I got it,
Oh,
it's graded, no worries. Okay,
thank you
so,
very much.
yeah, you're very welcome. Um, so this is such an important topic within the context of our course, because so much of what we're going to be discovering as the course proceeds is going to be that inflation is going to be a major part of the story. We started out the semester by looking at GDP, and of course, real GDP plus inflation gives you nominal GDP. So we know that, but we also know that inflation affects interest rates, it affects investment, it affects government spending, and it affects personal consumption expenditures and mortgages and housing markets. It affects the value of the dollar. Inflation is going to be with us for the remainder of the semester. So mastering concepts dealing with inflation is critical to the entire course. And I hope that you'll pay a lot of attention to all of the things that I've posted for you to read. And of course, that's my hope really for everything we do this semester. And I'll just leave it at that. I mean, you can read as much into that as you want. I think the message is pretty clear, given the fact that I told you I graded your exams already. I will post your exams certainly before our class on Monday. It takes a long time to post them because I have to post them by your social security number, and it takes time. There are 94 of you. It takes time for me to input all of those, and it's a bit of a mess. And of course, I have other classes. This afternoon, for example, another one of my classes is taking their first exam of the semester. So you'll have your grades by the weekend, and you'll be able to see how well you did, and we'll discuss the answers to the questions on Monday, as well as the homework on inflation. So at the end of the exam, we started to do some work on inflation. And the point I made that I think is really important pertaining to the first page is that inflation is a process, not an event. It involves acquiescence to higher wages and prices by multiple millions and millions of economic participants throughout the economy, or else you can't get inflation. Every time you agree to take a pay increase in an amount greater than the amount that you add to the productivity of your employer, you are being inflationary. But it goes on the opposite side of the coin. Every time your employer is willing to pay you that money, your employer is acquiescing. But it's the same thing every time you go to the store or buy a service and you pay more today than you would have paid yesterday, you're acquiescing to inflation. It's a process, and because so many millions and millions of transactions take place in an economy every single day, it's very hard to unwind it, either to get it going faster or even to slow it down once it gets going. You may, once you're convinced that the virus is, not a threat to you, you may want to go to a movie theater and see an action movie. You'll look at the price of a ticket, and I don't know, maybe it's $15 a ticket, and you look at it and you'll say, too much, I'm not going. But there's a line around the block of people who want to get in, who are willing to pay the $15. So what do? You're not willing, you won't acquiesce to the inflation, but others out there will. And this is exactly how inflation builds itself into a system. And so you're going to be hearing today, and again on Monday when we discuss inflation, you're going to be hearing a lot about trying to anchor the inflation rate and inflation expectations. Anchor meaning let's get it to roughly a certain level and make sure we keep it there. And then let's make sure that the expectations of market participants, meaning economic markets and financial market participants, that they are anchored in it, that they are reasonably sure that if we're posting a target of 2% on inflation, it's going to be roughly that as far as the eye can see. That means I can then make expectations for what things are going to cost me, how much wages I'm going to pay or expect to get, where interest rates are going, etc. So anchoring both the actual and the expected inflation rate is something we're going to be hearing about literally for the remainder of the semester. Okay? We don't want deflation, a process of generally falling prices, because that means businesses are selling things to us at a price that's less than what it cost them to make it or to get it from their wholesaler. And we don't want that. That's not good for profitability, and therefore it's not good for employment. And it just means that we're not doing well. We have not had sustained deflations in the US really since the Great Depression of the 1930s. There have been some periods where there has been some decline in the price level, but for a quarter or so, not sustained. I pointed out to you that maybe the most famous phrase in all of monetary policy theory is the phrase from Milton Friedman that inflation is always and everywhere a monetary phenomenon, and it is. But the work that I did in the 1970s with economist Peter Berman led us to a conclusion that, well, it's true, inflation is always and everywhere a monetary phenomenon, but it's vague. It's vague in that it's very hard to find a short-term relationship between inflation and money supply. Give me a period of an entire decade, and I'll say, well, money supply went up by, I'll make up a number, 35% in the decade. And wow, prices went up by 33%, almost the same. Money supply went up by 50%. Wow, prices went up by 53%, almost the same. Yeah, over long time periods. But over short time periods, inflation is really just a distributed lag relationship between money supply growth and inflation, with another thing built into it, and that is productivity. So if you look at the amount by which money supply grew over 10 consecutive quarters going backward, that will give you a rough estimate of today's inflation rate, but then you have to subtract off whatever productivity was. Why? Because money supply growth gives spending power, which is demand. Productivity gives you output, which gives you supply. And to balance the two off, if money supply is going up, giving you spending power, how much did productivity increase? And if productivity increased by a certain amount, that will reduce the inflation rate. It'll give you more supply. But even with that, the relationship between money and inflation has uncertainty such that, yes, Friedman is right, inflation is always and everywhere a monetary phenomenon, but all we know is too much money supply growth. And how much is that? We don't really know. For too long. How long is too long? We don't know. Will result eventually. Well, when is that? This year, next year, 2 years from now? We don't know. In higher rates of inflation, how much higher? We don't know. 4 different hedges here. What you take out of this is that the relationship between money supply growth and inflation is long term, and it's highly uncertain, and it's very variable. So you can't just say that if I know exactly how much money supply growth went up, and I know exactly how much productivity growth went up, I can forecast today's inflation rate. And the answer is no, you can't. You just know that too much money supply growth is inflationary. And if it goes on for a long time, however long that is, that's inflationary. And you're going to get that inflation eventually. But when? This year, next year, highly variable, uncertain, you don't know. And just how high is that inflation rate going to go? We don't really know. Wow, that's a lot of uncertainty. That's a lot of hedging. But it's really important because it's very common for some economists, for example, to look at the money supply growth. Just go onto the Federal Reserve's website every Thursday at 4:30. You get a weekly money supply report in the so-called H3 report, which you could have access to, and I would advise you to look at it. And you'll see the money supply growth, and you go, oh my goodness, inflation is coming because money supply growth in the past 13 weeks has been averaging 26%. That's enormous. It's historic. Yeah, well, where's the inflation? We're not seeing it. So you can't just draw that linkage because it's uncertain, it's long-term, and it's highly variable.
Well,
Very
Professor,
important conclusion. Yes, sir.
but you could still draw the linkage with like a certain degree of certainty over a long period of time, right?
Yes, but I would add this, Ahmed. I would say tends to. I would say that that linkage tends to work over long time periods. But you got to understand it's uncertain. The timing is uncertain. The magnitude is uncertain. So that if someone says to you, okay, given what you see with the money supply, what's the inflation rate going to be on December 31st, 2021? I would throw my hands in the air and say, I don't know. I know it's coming. I know that all the pieces are in place for it. I know it's coming. But you know what? Between now and December 31st, a lot of other things are going to be happening. Maybe the dollar strengthens, so imports become cheaper. Maybe inflation expectations go down because companies are not profitable. Maybe the growth of the economy we're all expecting between now and the end of the year due to the stimulus package and all of the Fed's accommodative policies. What if it doesn't do anything? What if people take the stimulus checks and they save the money, or they just pay off their debt and they don't spend it? What if they start spending more and more of it on goods and they don't get into the service sector, so we don't get service sector? You know, it's a human element. So many things can happen. And that's why I'm saying the relationship tends to be such that too much money supply growth for too long results eventually in higher inflation rates. It tends to, but is there a linkage? Can you testify that you can use this sort of formulation and on a particular date forecast what inflation will be? The answer is no, you can't. But there is a linkage there. There's no doubt, because we do know that if you starve the economy of money supply growth and you do it for a long time period, you'll eventually end up with disinflation. So we know that. But when, how much, all that uncertainty. So you want to walk away from this slide remembering these words: too much money supply growth for too long results eventually in higher rates of inflation. That is a tendency, that it is a long-term relationship, that it is highly uncertain, and it is highly variable. Look at all the different things that I'm telling you about this slide. Truly important. When we testified before Congress about this, we thought that we had found an econometric relationship that would work forever. 10 quarters of money supply growth. Man, we were forecasting inflation like nobody's business. We were the best at it. And by 1980 or 82, our model was totally obsolete. Didn't work anymore. But we had our moment in the sun, sitting at a table with a green tablecloth in front of members of Congress. That was it. So highly uncertain, highly variable, very long term, and a tendency. Okay. I love this slide because when I made this slide, I made the word "the" at the top of the slide in capital letters. Is money supply growth the cause of inflation? The answer is no. What money supply growth does, ladies and gentlemen, is it accommodates inflation. It's like fuel in the tank. Your car doesn't go unless you turn on the ignition, but you have to have fuel in the tank. You can't get high inflation rates if you don't have money supply growth. But is it the cause? No, there are many things that cause inflation. Look, there was some character today on Bloomberg television saying that the price of a barrel of oil is going over $100 a barrel. Right now we're in the low 60s, and that's way up because we're in the 30s. He's saying $100 a barrel. If that's the case, let me tell you, a gallon of gasoline is going to be at a level that will really make you scratch your head. Maybe above $4. Who knows? Maybe above $5. We really don't know. It depends on demand. So you look at that and you say, well, that would be a contributing factor to inflation, regardless of what happens to the money supply. That would be a factor. What happens to the value of the dollar? One of the most prominent forecasters of foreign exchange rates today from Rabobank in Europe, she's forecasting the dollar is going to continue to weaken. That would make imports more expensive. That would be inflationary. And then guess what? Out of the other corner of her mouth, her inflation forecast is that inflation is going to drop by the end of the year because she doesn't think people are going to be spending like crazy. She doesn't think there's going to be a big boost in aggregate demand. So who knows? But the key point here is that money supply is not the cause of inflation. It is the fuel that accommodates inflation, that allows it to keep going. What causes your car to go forward is that it is a mechanical genius. It's all those parts that make up your car. That's what gives you transportation. But it doesn't go anywhere unless there's fuel in the tank. Money supply is the fuel in the tank. And that's why we say money supply growth accommodates inflation. To accommodate something is to make it comfortable. It allows it to happen. So I want you to think about that word, accommodate. ACCOMMODAT. 2 C's, 2 M's. Let's skip this. This is just empirical. Now, one thing that's important to recognize, ladies and gentlemen, is that we have to ask, what is money anyway? And I love, again, the headline, money is whatever the Fed measures it to be. So we use different measurements of money supply. The most commonly used measure of money supply that we use is one of two things. We either look at something called M2, or we look at the monetary base. What is M2? M2 says, okay, take all of the different ways that you can hold an asset that is spendable immediately, that is totally liquid, like cash, like money in your checking account, which is spendable immediately. So you add cash together with money in a checking account, and you get something called M1. There are other things involved. I won't get into that. Put all the money that is in other checkable types of accounts that you might have. That's still M1 because all you got to do is write a check. Someone takes the check. You've paid your bill. Now add to it some other things like money that's in a savings deposit. Well, for the most part, it's really liquid. All you got to do is either online or go to a bank branch or an ATM and withdraw money or put it into your savings account. Or your time deposit, small little CDs that you might have, which have a lot of liquidity to them. That's M2. So think of M2 as being really the kinds of assets that we own that have a high degree of liquidity. And liquidity means the ability to spend it virtually immediately. Now, your textbook has some liquidity, but not very much, because you can't go into a store to buy a container of milk or some orange juice and say, here, I'll pay you with my economics textbook. That's not happening. You got to sell the textbook, get whatever you can get for it, then buy the orange juice. So everything has some liquidity, but we're talking about the things that have the most liquidity that make up M1 and M2. The monetary base, as you can see here, is the total amount of currency that's either in circulation or in the hands of banks, bank deposits held as central bank reserves. In other words, this again is high-powered money, money that could be spent virtually immediately. The point of all of this is the kinds of assets that we own, the kinds of liabilities on the Federal Reserve and others that could be spent immediately are what's relevant when we think about inflation. Because let's face it, if you are in a bank and you have a 10-year CD, which I don't know why anyone would do that, but if you have a 10-year CD, that money is not spendable by you for 10 years. That's not going to have any impact on current inflation because you can't spend it. It's sitting there, it's collecting interest for you. That's nice. Not very much these days, but it's collecting interest for you. That's a very nice concept. But it's not spendable now. And if it's not spendable now, it's not going to influence how much you get charged for any good or service that you may buy. So we're looking at the things that are most liquid as being most directly related to the inflation rate. Okay. Now, as you know, we have all kinds of electronic forms of money. These have come bursting onto the scene. They are growing more and more important. They also, by the way, are becoming more and more involved in consumer frauds of different types. As I'm conducting this class right now, my wife is doing a webinar for people in the state of New Jersey about exactly this, about electronic forms of currency and how they are creating frauds. And a lot of it is based upon what you get from robocalls, which I won't get into. That's her work. So we do have these forms of money. They are proliferating around the world. There really isn't a major central bank yet in the world that has gotten into Bitcoin or Bitcoin equivalents as the form of currency. That said, there are relatively smaller countries, especially in Africa, that are now using Bitcoin really as a basic form of currency. We haven't done it here. I think we're a long way away from having that in the United States. China is looking at it very carefully. The Canadians are looking at it very carefully. I would argue that all of them are quite a bit away from using it. But debit cards and PayPal and Venmo, they've all been around for a long time. Using Square, whose stock actually boomed yesterday, by the way, all very, very much more prevalent. And it creates issues for trying to measure exactly what the money supply is, because these are means of payment, but they're hard to count. That said, we still know that no matter how the Federal Reserve chooses to measure the monetary base, M1 and M2, all of which come out 4:30 in the afternoon every Thursday, the H3 report of the Fed, you can get a look at that and you can see how much these numbers have advanced. Now, we have been using a fiat form of money in the United States really entirely since 1971. Make no mistake about it, the United States is not now, nor really has it ever been fully on a so-called gold standard or gold convertibility standard. In August of 1971, any relationship between money and inflation for the United States was suspended by the president at that time, Richard Nixon. There was a time when you could go to a federal facility with, first it was $32, then it was $35, and then at the end it was $38.22. And you can say, I want an ounce of gold. And you can convert cash into gold. And you would get gold that was at least 99% pure, which is really quite amazing. That stopped. When there was a gold standard, it really meant that there was a linkage between the amount of currency that was in circulation and the amount of gold that a country held. So you could go to the Federal Reserve Bank of New York on Liberty Street in Manhattan, which is where I worked for 17 years, and you can get a tour of the gold vault. You'll go down, you'll see the largest aggregation of monetary gold that we know of anywhere in the world. There are about 530,000 bars of gold. Each bar of gold is roughly the area of 400 to 410 troy ounces. And if gold now is what, $1,800 an ounce, you could figure out what the value of that gold is. It's a lot. It's many, many, many billions of dollars. And effectively, it's useless because countries are not on gold standards anymore. It's valuable in that it's gold. And most of the gold, almost all of it in the gold vault there, belongs to other countries and central banks around the world. There is some US gold there, but most of the gold there is the gold of other countries. They're kept for safekeeping 5 stories below ground in what we think is the largest gold vault in the world. There was a movie starring Bruce Willis called Die Hard with a Vengeance, where fictitiously they tried to steal the gold out of that gold vault. Some other time when I won't waste your time, I'll tell you about my role in that movie. There's actually a character in there based on me. But that's a long story. Anyway, that said, we are not on any kind of a gold standard. So what we have effectively is what we call an elastic currency. It's a currency that actually grows or shrinks depending on the growth of the economy. Think about the word elastic. You're probably now wearing at least something that has some elasticity. Maybe it's a waistband, on your undergarment, or maybe it's your socks have elasticity. But if you have a waistband, you know that if you take a deep breath and open up, that waistband will expand. Expel the air, the waistband will contract. What that's really saying is that the money supply tends to grow, not because of anything really that the Federal Reserve does. The money supply tends to grow, well, I'll come back to that in a minute. The money supply tends to grow as the economy grows. Why? Because as the economy grows, there is more demand for credit. When there's more demand for credit, there are more loans. When there are more loans, those loans get deposited into the bank account of the borrower. And as soon as that occurs, the money supply has gone up. Then the borrower spends the money, somebody else receives it. That person or business that receives it deposits it in his or her bank account or the company's bank account. And now you have more money in the banking system to create still more credit. And it goes around in that circle. Well, you get more of that type of activity when the economy is strong than when it's weak. More people will borrow for housing. More people will buy cars. More businesses will expand. More businesses will modify and upgrade when the economy is good. So you get credit growth, which results in bank deposits, which results in the money supply going up. And that's the currency, which results in more spending, which results in more receiving of money and more money getting back into bank accounts, and you go around and around like that. So we say we have an elastic currency, a money supply that grows when there's more economic activity, a money supply that grows much slower when there's less economic activity. What the Federal Reserve does is try to accommodate these demands for credit by using its open market operations, which we'll discuss at a later date, to try to make sure that demands for credit are met by there being enough money in the banking system at any moment in time. That's the Fed's job, consistent with its mandate to maximize employment and bring us price stability or 2% inflation rate. I'll stop right there for a moment and ask if you have any questions about this. Okay. I hope that's a good sign. I hope you're just not being shy, because this is going to appear on your next exams, I can promise you, in great detail. So don't be shy about asking questions. All right, I'm going to skip the money multiplier because I won't test you on it. So why do we hold money? Why do we even want to have any money? Well, the obvious reason is you and I want to have money because we want to make transactions. We want to buy stuff. And that forces us to keep some money available to us in some sort of spendable format. Either it's on deposit in our checking account or a Venmo account or even a Bitcoin account, or maybe it's just money you hold in your pocket or you keep safely in your apartment or home. You want to make transactions, and in order to do that, you need money. But there's another kind of transaction you might want, and that transaction might be a financial transaction. Maybe you want to have money because you want to save it or invest it. So we'll come back to that, but that's a kind of transaction too. It's a financial transaction as opposed to being an economic transaction. But the key reason why we want to hold money is we want to spend it. Precautionary balances. I did a lot of work in my career teaching personal finance to people from high school ages up to retirees. I was very big on personal finance and trying to promote it, especially among young people your age. A precautionary balance or a precautionary motive says, hey, look, stuff happens and there's a safe amount of money you want to be able to have in sort of a crash and go bag somewhere. So what does that mean exactly? Well, normally we tell people, depending on their age, depending on other life circumstances, that they should think about the amount of money they use for spending in a typical year. So let me pick a round number just for simplicity's sake. You spend $30,000 every year on stuff. Whatever that is. It could be your rent, it could be your electricity, your cable bill, TV bill, whatever. You spend $30,000. As just one singular number, we tell people, if you're spending $30,000 a year, you need to keep as cash that you could get immediately, and I mean immediately, at least 1/3 to 1/2 of that amount. So if you spend $30,000 a year, you should put aside somewhere, I'm not going to touch this, between $10,000 and $15,000, between 1/3 and 1/2 of what you spend in a year. Why is that? Because who knows, maybe you'll get injured. Who knows, maybe there'll be a pandemic and you'll lose your job. Who knows, maybe you'll be robbed or defrauded or hacked into your accounts and you lose the money. You need to have that money. And you need to have it in a way where you can get it. So maybe you want to keep it as cash in your home. Maybe you want to keep it in a bank, in a very liquid kind of an account, like a checking account, but a bank that has many, many, many branches all over the country, like a Bank of America or Wells Fargo or Citibank or Chase, JP Morgan Chase. Why those? Because if you keep it in a very small bank that's localized, and something happens in that community, you're in trouble. I remember going down after Hurricane Katrina in 2005. I was down in Mississippi where I was working with the communities down there on this kind of an issue. And the thing was, people had their money in a local bank. It had one branch. Well, that branch was closed. It was flooded. There was no electricity. The ATM machines didn't work. People couldn't get at their money. But if they had their money, say, in Bank of America or Wells Fargo or something like that, they could have gotten in their car or on a train, gone to a bigger city, maybe 50 miles away, where the branches were open, and they could have gotten their money. So you want to keep precautionary balances about 1/3 to 1/2 of what you spend in a year, money that's put aside like that. There's a speculative motive. maybe a bit of a misnomer. But what this is really saying is that you want to keep money in the forms that are very liquid because you may, just may, be spending it on something big sometime soon. So, for example, if you are saving money now so that you could afford to pay your tuition next semester, you're not going to put your money into a 10-year CD. That's ridiculous. You're keeping your money now, you're letting it build up so that when your next tuition bill comes, you can pay. Or maybe you have a broken down old car and you know it's on its last legs and you may need to get a new car or just lease one, but you need to have the money available to do that. Or maybe later in life, you're looking out and you're saying, you know, I'm anticipating getting married and maybe I'm going to have a child and maybe I'm going to buy a house. Maybe I don't want to tie up my money in a 10-year CD in the bank. That's the speculative motive. Now, the key here is to think of money as an asset class. We think of stocks and bonds and derivatives and commodities and real estate as being asset classes, and they are. But money is an asset class too. It's an asset class with a 0% nominal rate of return. So yeah, it's an asset class. It just doesn't pay a positive rate of return. Well, that's pretty darn good if you're in Europe where interest rates are negative. They're getting negative interest rates. They're paying the bank to hold their money. Well, that's one thing. So actually, if you're paying the bank to hold your money, a 0% is actually better than negative. But most of the world is not in that kind of a situation. So you look out at it and you realize that every dollar that you hold in a super liquid format like cash or just money in a checking account is yielding you a 0 rate of return. But it's losing its real value because while it's sitting there and not losing any nominal value, you deposited 10,000 as cash or you have 10,000 in cash in your pocket, it's still going to be 10,000 in cash. But as time goes on, it's going to buy you less and less and less because of inflation. So it's losing real value. So nominal value minus inflation gives you a real value. Your real value is going to be negative. And so most of the time we try to economize on our cash holdings because it doesn't yield a positive nominal rate of return. So this is something for us to be talking about. Again, we'll do more of this on Monday and maybe even more on Wednesday, depending on how far we get. Okay? So we look at what we call a demand for money function, something which really is in all economics textbooks. And by the way, all of these slides you see with the blue banners that you see here, if you look at the bottom, it says 2017 Worth Publishers. This is all coming out of my Economics 101 textbook. So this is all stuff that was actually from your previous course. Okay, demand for money in Friedman's analysis depends ultimately on the amount of wealth held, the opportunity cost of holding money as compared with new assets, and individual tastes and preferences. Wealth. Every one of us has a certain amount of wealth. In fact, wealth has become a really big issue this past week because Elizabeth Warren has been talking about creating a wealth tax on people who are billionaires. We'll see how far that goes. Every one of us has wealth. Some of us have a lot, some of us have a little, but we all have some sort of wealth. How do you measure it? Well, if you think about it, your wealth, consists of everything that you own. Think of it as your assets. Your assets are your wealth. You do have clothing, you do have books, you do have, you may have a vehicle, maybe you have some jewelry, maybe you have cash, maybe you have investment accounts. Who knows? It varies from person to person. Everyone has wealth. Some have more than others. But what Friedman looks at is wealth in a very, very interesting way. We'll come back to these concepts again when we discuss consumers. But what's interesting is Friedman saying, okay, your wealth is one of your determinants for how much money you actually want to hold for transactions, precautions, and speculation. Your permanent income. Friedman said, hey, look, every one of us has some perception of our permanent income. What does that mean exactly? Well, your permanent income, he would argue, is your perception of how much you are going to earn over the next 3 years or so. Why 3 years? Because Friedman argues that our time perspective beyond 3 years is too fuzzy. So he would say, hey, look, if I were to ask each and every one of you, how much do you think you're going to be earning in 2021? For the most part, each and every one of you would give me a number, and it would be pretty close to being accurate. You may not get it exactly right. And of course, we know things happen. Maybe you're graduating this semester and you end up with a job that you never anticipated. You never knew how much you were going to get. Yeah, I get all of that. But Friedman said in your first year in your purview, going out, let's say to the end of 2021, you have a pretty good sense of how much you're going to earn. If I said, all right, well, what about 2022? Friedman said, yeah, you'll come up with a number. It won't be as accurate in terms of your perception as your 2021 number, but it'll be pretty good. Well, what about 2023? He said, well, that's going to be a little fuzzier, but it won't be that bad because most people get jobs and they go up 2-3% a year. That's what they get. If you're a bus driver in New York City, you're not going to get a 10% raise, and you're not going to get stiffed either. You're going to get a couple of percentage points. If you're a college professor, if you're an adjunct, probably not going to get anything because that's the way it works. But maybe you will, maybe you won't. But he argues you can go out about to the third year. After that, it becomes really fuzzy. Your life changes too much. So he said, hey, look, people get a perception of their permanent income and their behavior in the marketplace, especially for transactions, depends upon that. If you're expecting over the next 3 years that your income is going to go up by a total over the next 3 years, let's say of 5%, that's probably not going to encourage you to go out and try and buy a Lamborghini or a BMW. You're probably not, because you're not going to be moving up a lot. But, if you say, hey, look, I know that I just got a great job with Goldman Sachs or with JP Morgan Chase, and I know what the earnings possibilities are for a trader, within 3 years, I might be up over $500,000 a year in comp. Maybe you will go out and buy a Lamborghini. Who knows? But his sense is that your perceptions going forward will determine how much you want for transactions, precaution, and speculation going forward. And that perception is based upon where you think your income is going to be over the 3-year period coming up. But he also points out that your perception of wealth depends upon the ratio of non-human to human wealth. What exactly does that mean? Well, just suppose you have non-human wealth, which is what I just described to you. What assets do you have? They're non-human. What accounts do you have at a bank? What brokerage accounts? Do you have any real estate? Do you have fancy jewelry and artwork that you could sell? That's non-human. But your human wealth is your human capital. And so you may not have a whole lot of that non-human wealth now, but you're in med school and you know that the time is going to come. You're going to get out of med school. You're going to have an internship. You're going to have a residency. And then, bam, you're going to be making a ton of money over the next 30 or 40 years of your life, because that's what doctors do, especially in New York. If you know that to be the case, your behavior in the marketplace is going to be very different. You may not be spending a ton of money now, but you know that when you're in your 40s and 50s, you're going to be spending a lot of money because you have it. And not only do you have it now, it's going to keep coming in. That's your non-human wealth. That's your human capital, what you know, and your skill set as a physician. So that's what he's talking about here. Secondly, the opportunity cost of holding money. I already pointed out that if you're holding money in the form of cash, there's a high opportunity cost. Why is that? Because you have a 0% nominal rate. Meanwhile, inflation is going up, so the real return on cash is negative. So what are we looking at? Opportunity cost of holding money. What are the interest rates? When I was a student interest rates shot up not only into the double digits, they shot past 20%. If that were ever to happen in the US, you'd be nuts to keep money in the form of cash in your pocket. You'd be running to the bank to get it in there. Because if the interest rate is 20%, your money is doubling in 3.5 years. Oh my goodness. I was fortunate. I had a small amount of money, and it really was small, at a time when Treasury securities were paying 18%, which meant that my money would double every 4 years. Remember the rule of 72 that we discussed in the beginning of the semester? So you could take $10,000, and in 4 years you've got 20, and in another 4 years you've got 40, and in another 4 years you've got 80. And look what happened with $10,000. That's the opportunity cost. If I had not bought those Treasury securities, if I had held cash in my pocket, if I had stored it somewhere in my apartment, that never would have happened. So that's how you get, a lower middle class kid from, between Maine and Casino, right along the LIE, which is where I grew up. That's how you get a middle class kid who suddenly has some money. But you know what? The opportunity cost now from interest rates is really low. You don't want to be holding massive amounts of Treasury securities now when the interest rates are barely on a 10-year up to 1.40. The opportunity cost is low. The incentive to holding cash is a lot better. If you expect the price level changes, hey, I want to hold on to money now and spend it now if I think prices are going up tomorrow. Think about it in simple terms. If I told you they were raising the cost of a subway fare from $2.75 up to $4.75, you'd be buying Metro cards right now, or making sure that you load it up on them. And of course, the same thing holds with price levels. If I told you that your tuition is going up next month, but if you prepay it now, you'd have an incentive to prepay it now. So that would make you want to hold more cash now. And then, of course, there's tastes and preferences. Okay. I don't know about you, but I love this topic. So we now turn to the arbiter of monetary policy. Monetary, of course, the root of the word being money. Someone posted a question before and said, so gold does not have a relationship anymore to the amount of money that's out there? And the answer is that's true. The amount of money that is in circulation and on deposits in the United States, and really everywhere else, has no link at all to the amount of gold that's at Fort Knox and in Denver, Colorado, and in Washington, D.C., and a little at the New York Fed. Gold and money supply are not related anymore in any way. So the amount of gold we have as a nation, and it's not the most of any country in the world, by the way, the amount of gold we have as a nation does not dictate the size of the money supply. So with that reality, Congress gave the Fed a mandate. Mandate, mandato in Spanish. This is the mandate. This is what you got to do. You have to set conditions in the economy and the financial system conducive to the achievement of full employment of workers and price stability. Let me stop right here and emphasize a very important word that is left out of the thinking of too many people who comment about the Federal Reserve, from brokerage houses and college professors. The word conducive. They're setting conditions conducive to something happening. What that's implying is that they can't make it happen. They just set conditions conducive to something happening. So if I get in your face and I get nose to nose with you, and I've got really bad breath, and I'm screaming at you, and my nose and your nose are an inch apart, that's conducive to you popping me in the mouth. Bam. Or pushing me away. It's conducive to that because I set that condition. I was up in your face, breathing in your face, stinking you out with my bad breath, making you annoyed. That's conducive to you pushing me away or punching me. Think about it. Think of all the allegations this week against Governor Cuomo. The last woman that made accusations, said, and had a photograph of his hands on her face. That is conducive to her saying that he is intimidating me, that what he's doing is inappropriate. I didn't ask him to put his hands on me. I didn't give him any signal that said it's okay for you to put your hands on me and ask you if it's okay to kiss you. That's conducive to her going to the media and saying, we got a governor who can't keep his hands off women. That's conducive to it. Now, he may have been totally innocent. I mean, I was in the hospital yesterday for chemotherapy, and one of the nurses said to me, this stuff is really nonsense. That's what single guys do. And he's a single guy. But the answer is he's the governor, and it's the governor, keep your hands off people. You don't ask a woman significantly younger than you about her sex habits and about whether or not it's okay to kiss her. You don't do that. A single guy, maybe, maybe not. I don't know. It depends on circumstances. But the governor, no, that's not right. That's conducive to her going public and saying I was intimidated. So what the Fed does is set conditions conducive to the achievement of full employment of workers and price stability, but they can't guarantee it. Lowering interest rates, which is what the Fed can do, pumping a lot of reserves into the banking system, which is what the Fed can do. Other different programs the Fed is allowed to do can make the economy stronger, but they can't make XYZ company hire more workers. They can't force either a big company or the grocery store or the bodega down the street to hire anybody, even though the goal is full employment of workers. And they can't tell businesses how much to charge. You can't tell Tesla how much they have to charge for their electric vehicles. But they can set conditions that could make price stability possible, but that doesn't mean it's going to work. So you have been in situations many, many times in your life when you tried to do something to get a result that you were hoping for, and it didn't happen. You set a condition conducive to something, and then it didn't work out. So that's the best they can do. But the mandate is to set the conditions conducive to full employment and price stability. And ladies and gentlemen, you will hear this term over and over and over again, not just in this course, but really for the remainder of your life. That what the Fed does is try to maximize employment and bring stability. It got started with the Employment Act of 46. It got pushed forward in 1978 with the Humphrey-Hawkins Act, again, to set conditions conducive to that with slightly different language. Set conditions in the economy and financial markets consist of the achievement of maximum sustainable real economic growth and stable prices. Yes, Jackie, that would be the case. Maximum sustainable real economic growth. With this particular way of thinking about it, the way I describe it to classes all the time is this way. I know a lot of people who run marathons. I'm not one of them. Can't do it anymore. I have artificial hips. But I know people who run marathons, and the question I would ask people all the time is, what is the strategy for winning the New York City Marathon on the first Sunday of November? The gun sound to start the race, and you start running across the Verrazano Bridge as fast as you can, and you run as fast as you can for as long as you can? And the answer is no, you won't finish the 26 miles, 385 yards. You won't. So what do? You try to find a pace such that not only will you be able to sustain the pace and keep going for the full 26 miles, but that it's the fastest pace that you can run that will get you through the 26 miles. And if you do that, that's how you're going to get your best time. Find the fastest pace that you can run without falling down, without hitting the wall in the 18th or 19th mile so that you can't move and your legs are crying and your feet are saying, the dogs are really barking inside your sneakers. No, you got to find the fastest pace that you can keep going and sustain that pace for the full 26 miles, 326 yards. What does that have to do with the Humphrey-Hawkins Act? That's what we're trying to find. How fast can the economy grow consistently persistently to get us the maximum amount of economic growth. And if we get that, we're going to get maximum employment, consistent with the Employment Act of 46, without us getting into a problem with the economy overheating and prices becoming unstable. Notice where we're going. Price stability is in here, maximizing economic growth so that we could maximize employment. But when we maximize economic growth, we don't want so much of it that the economy overheats. This, by the way, is the issue that many people in Congress are looking at now with the stimulus bill, saying we're going to overheat this economy and we're going to end up with unstable prices. That's not going to be maximum sustainable real economic growth. It's going to be this big jolt when people get all this money. And yes, some of it will get spent and it'll be good for the economy, but we will not get stable prices. That's not the way to win the marathon. So just keep that in mind. And then in 2008, in the midst of that financial crisis, Congress passed something called the Dodd-Frank Act. And effectively what they said was, okay, you've got maximum employment as your mandate. You've got price stability as your mandate. Let's make it a three-legged stool and say that the Fed should also promote stable financial markets. Three-legged stool. When you talk to people inside the Fed, they still emphasize full employment of workers and price stability, but make no mistake about it. If there is a fire that's raging within the financial markets, the Fed will do what it can to put it out. So it is a three-legged stool now, the past dozen years or so, with price stability, full employment, and stability, with the Fed setting conditions conducive to achieving those three goals, that three-part mandate. Okay. I think we'll do just one more. Well, we have a little time. When inflation went haywire. Ladies and gentlemen, there have been places on Earth where inflation has gone completely nuts. In the 1980s, there were something like 20 countries in the world that had an annualized inflation rate, meaning an inflation rate that at an annual rate exceeded 1,000%. There were countries where the inflation rate at some time exceeded 6,000%. Some of these were in Africa, some were in the Middle East, some were even in Europe. I don't know why I said even, but some were in Europe. We'll see some of these numbers in a minute. And in almost all of the cases, the problem was that there was too much money supply growth. Now remember, inflation is not caused by money supply growth. It is accommodated by money supply growth. And in some cases, the problem was that governments said, well, we don't have tax revenue in order to pay for the things we want, so we'll just print money. Well, you can do that. And if that money then gets spent, it's the spending that causes the inflation. If that money then gets spent, you can end up with some massive money supply. I'm sorry, with some massive inflation rates. That was particularly true in countries like Zimbabwe, Russia, Poland, Israel, Ecuador, Argentina, Brazil. These were countries that saw enormous growth in the money supply. Let's take a look at some of the numbers. Inflation rates vary widely across countries. Now, this is a snapshot just from the year 2016. Why am I focusing on 2016? It was just a set of numbers that I could get. But it really makes the issue very, very interesting. Look at Venezuela's inflation rate, 475,806% annualized. Look at that. But then you get to countries, look at that. You see countries like Japan that had deflation, Greece, deflation, Italy, deflation. It really varies a lot. The United States at that point had an inflation rate of 1.88, 1.2%. At that point in 2016, you had a country like Venezuela with a 475,000 inflation rate. What is that saying? You got to keep pumping money in so that people can buy stuff. If you are a restaurant, how do you even post a menu where people know what they're going to be paying? Because the prices are changing literally every minute. And so what we found in a lot of countries, if you look at restaurants, for example, prices were not ever printed. They were put on chalkboards, and like every couple of minutes, the price kept going up because that's how people lived. People couldn't do any planning. People were always finding themselves behind the eight ball because they get paid less frequently than prices go up, so they found themselves getting massacred. So why do inflation rates so widely vary across countries? Different monetary policies, different fiscal policies, different rates of productivity growth. Remember, I said in my own work with Peter Berman, we looked at the money supply growth, but we also looked at productivity growth. We put the two together in the same econometric equation. Money supply growth propelling inflation, productivity growth holding inflation back. Different structures to the economy. Some economies are based upon commodity prices, and if commodity prices are soaring and you have to buy a lot of commodities, you're going to see a high inflation rate. Others are based upon more service-based economies like ours, and you're in an environment where service industries are getting hit. You're in an environment where services are getting hit like cruise lines, airlines, hotels, beauty salons, nail salons, etc. You look at that and you say, okay, if people are not buying these things, then prices are not going to be going up very much. And so when you look at a chart like this, Angela, and you see at the bottom, you see negative inflation rates, it means they are deflating. That is deflation. That's the general level of prices going down instead of going up. That's often a sign of weakness, not of strength. So when you see the negative rates there, it means the inflation rate is negative, which means they are deflating. That is a deflation rate. That's the negative numbers. I wish there were more questions. This is not easy stuff. Hyperinflation. You're very welcome, Angela. These are some looks at some countries that had hyperinflation rates. Just take a look at some of these numbers. They're off the map. And look at some of the time periods. A lot of it was in the 20th century, where you had episodes of phenomenal inflation rates. Numbers that are mind-boggling. I'm going to stop here because the work that's coming up on slide number 18 is quite complicated, very important stuff, and it's really important that we're able to handle it in some detail, which we'll start to do on Monday. So again, Monday we'll go over the test. That'll be fairly quick. It's only 38 questions. We'll go over the test. I will post the page with the answers on it for you to benefit from. So you don't have to take notes on the answers. I'll post the answers for you. I will post your grades, not by name, but by your identification numbers. So that's all private. That'll all be done before the end of the weekend. I encourage you again to do the reading. And if you're very time constrained over the next 5 days or so, just read the article I just put up today, which is on the inflation outlook. It's a newspaper article. It runs 2 pages. I think it's wonderful. And as you read it, you might want to make note of the various things that are in that article, which we've already covered, but then other things that you know are related to this course. As I said, one example is there's a great discussion of multiplier effects, which I know you covered in your Economics 101 class. So I will take a deep breath. I will end the class now a little bit early, and wish you a really, really good next 5 days. The weather is going to be much warmer. I hope you'll have an opportunity to get outside and enjoy it a little bit. And thank you, Nan. And I appreciate you being with the class today. There's, a smaller number of you than normal. I don't know if that's exam fatigue or exam disappointment. I don't know what it is, but I appreciate you being with us today, and thank you to those of you who asked questions. So let's meet again on Monday.